everyone for joining. I'm going to start with Carl because Carl, unfortunately, couldn't be with us in person today, but we want you to feel very much part of the discussion that we're going to have. I hope you were able to listen into the presentation that we just made. Do your views as a reserve manager at the Central Bank of the Philippines sort of tally with the results of the survey that we just presented, and what are the main challenges that you're facing at the moment?
Hi, Clive. Can I just check if you can hear me?
Loud and clear. Thank you very much.
All right. Thank you so much. So actually, with what you presented, what I can say from at least what I observed from where I sit is that we generally share the results of your survey. So in terms of challenges, you noted quite a bit of them, but at least for us, what we see as a challenge for the RMB market, or maybe one of the barriers to investment for conservative institutions, is maybe perhaps the liquidity, or maybe the need to further enhance liquidity. So this may be an issue for investors like us who would like to manage bond portfolios against a benchmark. And we have observed that it has been easy to sell bonds, but maybe the other side is not as easy. We do note that there have been efforts in the amelioration of this liquidity issue by according the use of direct trading platforms such as Market Access or TradeWeb and Bloomberg. And in the offshore market, there have also been efforts on electronic trading, but liquidity still remains a bit challenging. Another challenge maybe that I would like to highlight is the onshore RMB market has a different trade life cycle compared to other markets. So I guess for most of us here, we're very much used to US or European markets and the degree of flexibility that is accorded to investors in those markets. So that's something that is still not, I guess, in the same footing in China. But that said, the recent optimization efforts of CIBM aim to reduce this barrier by extending the trading hours in CIBM for trades with T+1 and above settlement cycles. And mainly one final challenge that I see, at least from where I am in the world and being a conservative institution that the BSP is the current state of affairs. So there was a discussion briefly on where we are in economics and politics, and these are always in the background. And in terms of where we are now, the divergence in monetary policies between other major central banks and that of the People's Bank of China is starting to become apparent. Of course, there's a diversification angle that one can think about, but I guess those are the main challenges that I would see from purely an investment standpoint.
Thank you, Carl. And just to quickly follow up, and hopefully not asking you to reveal more than you can reveal, but what you said was interesting about the onshore RMB market. So how are you accessing the RMB markets at the moment?
Yeah. Okay. So for the onshore RMB market, we are in the CIBM space. So the BSP has started initially offshore as early as 2013. So we initially looked at going into China through the QFII avenue, but regulations kept on evolving, and so we started with the offshore CNH market back in 2013. And then we moved on. So that was currency and bonds. And then we moved to onshore CIBM. I think it was sometime in 2018. And we have, I guess, increased the size of our investments. And I guess in a way, we are a bit familiar with the market from that respect. And that's actually where our comments, or my comments on liquidity stems from. So yeah, so that's how we do it, through the onshore CIBM.
And what role do Hong Kong's markets and access that you can get via Hong Kong play for you?
In terms of Hong Kong, the way we would manage the portfolio is that, for one, we are only in the fixed income side. Our charter would prohibit us from going to equity. So since we do have access to the onshore CIBM, what we do is that as a central bank, we have the flexibility to look at rates onshore and offshore, CNH and CNY, China government bonds, and we have access to the issuances of Supras and the like. So for us, it's more looking at where we can best find value, whether onshore or offshore, and just trying to make the most of our investments. And I guess what's important for us is to be nimble because as you may be, I guess as some of us are familiar with, the yield levels off and on tend to move around quite a bit depending on the situation in the market. So yeah, generally that's how we would navigate between offshore and onshore.
And Carl, just a final question to you for now. How did you, as an investor and asset allocator, navigate last year's difficult markets? As you say, no equities in your portfolio, very much fixed income focused.
Yeah. So for us, as it was mentioned earlier, pretty much a bloodbath. But going back to what I mentioned about diversification, I guess for investors who were in China, we saw less steep losses. Dollar returns from a dollar returns perspective. So yeah, I guess most of the portfolios have been underwater, but some more than others. And the exposure to China definitely helped, I guess, cut the bleeding a bit, so to speak.
Hopefully 2023 is treating you better. I'd like to come to Jinwo now because we're delighted to have CIC here. Obviously not an investor in China, China's investment overseas arm, but we certainly count you from OMFI's point of view. We have the group of what we call global public investors, which includes reserve managers, public pension funds and sovereign funds. So it'd be just very interesting to hear your take on the challenges as a very large, very influential, diversified international investing sovereign wealth fund, how CIC has been adapting to recent market trends.
So actually, I think that your survey is also our consensus internally by CIC Hong Kong. So I think in the first half of this year, for the investor, it is not so difficult because of the macro environments, because the disinflationary trend continued, and also that we can see that development countries have robust economy, much better than the expectation at the end of last year. But I think maybe in the second half of this year, we will face maybe more challenges for the macro environments. Especially if you look at the core inflation of US and also the Europe, it's remained very sticky. And also, I think maybe in the second half of this year, this inflationary trend would maybe slow down. And also by the growth, that's maybe we will face more challenges because of the cumulative lagged effects of the monetary tightening. So I think also the geopolitics is also very significant for the sovereign investors. Internally, we also have to continue to follow up these trends. We don't have insight, but we have to continuously follow up this trend to adapt to the new environments of the macro trend. Yeah.
So you're more confident maybe than you were 6 months ago, 12 months ago, would you say, in terms of the markets being accommodative to you doing well in them?
I think for the broad macro environments, I cannot say compared to 6 months ago, I got maybe more confidence, but we still need to be patient and to get more information about what the central bank will do next step, and what the economy will maybe react to the tightening of the monetary policy. So we need time. I think.
CIC has used external managers a lot in recent years. A lot of the portfolio is managed by external managers, whether it's the likes of Neuberger Berman sitting next to you, or whether it's private equity funds, or whether it's hedge funds. Is that something that you will continue? Is that something that you feel like you've benefited from through this difficult market environment?
Yeah, according to our maybe annual reports of 2021, the external manager managed the 62% of our total portfolio. I think it's very important to learn from the external manager. We just learn a lot and communicate a lot and frequently with our external managers. But at the same time, we also build up our internal management capability. I think especially for the CIC Hong Kong, our internal management level has improved much, I think, in the past 10 years. But at the same time, we still need to frequently talk with the external manager and exchange our views on the markets, on the economy. Yeah.
Thank you, Drew. Mark, if I can turn to you now. Mark wears two hats here, really, as both a chair of Asia for ONFIF, but also in your role of chair of the investment committee at Hester. And I'm not going to ask you to speak on behalf of the entire Aussie fund industry, but you might speak a little bit about how China and Hong Kong are viewed as investment destinations right now.
Yeah, look, I can't comment for Hester per se, so this is more a general comment about investing in Hong Kong and China. Look, it's a market that's critical for Australia. So we view it two ways. We view it obviously from an investment destination, but also its influences our largest export market, the influence it has on the Australian market. People, I think there's been a lot of discussion about flows in and out of investments in Hong Kong. And there's no doubt that the controls that were put on in relation to Ukraine and Russia did frighten people temporarily. But we need to also consider what investors were thinking about the cycle of China. It's been talked about today, and I think this is really worth emphasizing, is that it's a diversifying asset, and it's proving to be a diversifying asset. The flip side of that is that China is going through a restructuring process. It's fixing some balance sheet issues in relation to real estate, I think very wisely for the long term. Interest rate spreads have narrowed, so Chinese bonds are less attractive. And so we've seen more recently some flow in the last 12 or 18 months of people playing the cycle, reducing their weighting to a market that is going through a cyclical adjustment. And that is just normal asset allocation. We saw this in the US when it went through cyclical adjustments in the 1990s. It underperformed for a period. People de-weighted away. But I think Australian investors have a long-term approach. We're certainly would like to see continued growth and development of the financial system in China, development of unlisted assets and other areas which Australian institutions have large exposure to. So, we're positive. People have leaned into it a bit recently because it's been going through the cyclical adjustment. But as a diversifying asset, it's proving to be an interesting place on which to develop the portfolio.
And to what extent is Hong Kong still a great gateway to that market? I mean, you talked about, and we heard Carl talking about going onshore. So there's obviously a big desire to go onshore where possible. And yet the chances remain limited. So Hong Kong still plays an important role.
Hong Kong plays a vital role. And I was up here a couple of weeks ago with the Hong Kong Stock Exchange, hearing what they're developing, the creativity that they're coming to the table. Eddie talked about it this morning in relation to filling out some gaps in the product range that Hong Kong will develop for international investors. I think Hong Kong, the most important thing is we're back together seeing each other. And I think that's taken a little bit of time. But, Hong Kong is clearly a vital gateway and investors are viewing that way. And I think on the other side, Hong Kong is being very creative, but considered in the way that the connects are developing, products are developing, the way the exchange, for example, is developing. And then, of course, the HKMA's kind of policy approach is, I think, creating a kind of a stronger franchise, which was already existing. And so people are viewing it that way.
I think there's something interesting here. I wonder what your thoughts on this are, where I think most overseas funds will still see China as an emerging markets play of a sort. Yet Hong Kong is not an emerging market by any sense of the word. It's very much a developed market, and yet is a gateway to China. So how how do you sort of like square off that emerging markets versus developed markets side?
Well, I think, with due respect to China, China is a massive country with a massive series of characteristics. It is no emerging market when you visit many Hong Kong cities. They are sophisticated, super developed, fabulous entrepreneurial environments. But generally, and this is the bull story of China, it is an emerging market. But policy development, it's in particular in relation to financial, the kind of welcoming of financial foreign institutions, for example, some of these things are very kind of steadying influences. But as you said, Hong Kong and its kind of track record acts as a gateway to that. And I think we heard this today from Eddie, that's a comforting aspect that gives people that degree of access. And I would strongly encourage Hong Kong policy to keep that going, because I think it's very helpful for the development and the diversification of the Chinese financial system to have those gateways.
Thanks, Mark. Kerrigan, if I can come to you now, Legal & General, a very well-known name in many parts of the world, with, I think, some ambitious plans in Hong Kong and China, and also some interesting insights into how things like the pension fund industry might develop in China as well. So just to start off with, what's Legal & General's investment approach towards Hong Kong and China?
Yeah, perhaps just a little bit of context on Legal & General to help me answer my question. We're a pensions investment and insurance company, so we have the benefit of roughly 100 billion US balance sheet, our own money, and then a further 1.4 trillion US that we manage on behalf of third-party investors. And so I'll give my answer in the context of what we do on our own balance sheet usually signifies what we'd like to take as products, services, or co-investment to our third-party investors. And really, we've talked about some of those things already in terms of our own asset allocation on our balance sheet. Of course, it's diversification and returns. And I'm just going to briefly talk about equities, private, public, and then fixed income over the last year and how we think about that going forward. Diversification, I probably don't need to talk too much about that. We've talked about the orthogonality of the US and Chinese economies at the moment, and that gives opportunities combined with the huge underweight relative to GDP in most asset allocators' portfolios. So diversification, let's leave that for a second. But returns, I think, really interesting. Let's talk about equities and what we're doing on that front. It's not the whole of Chinese equity markets. We talked about the huge diversification, the opportunities there. What's really interesting to us is the growth area. So we think about it as deep tech. so that science and manufacturing driven growth in technology, particularly signified as clean tech. So the world leadership in EVs, power batteries, solar, those sorts of things. That's incredibly interesting, driven, of course, by government policy, the size of the domestic consumer market, and the applicability to the world. So this is a hugely interesting growth area. We're putting money in there on public and private equity side, and looking to take that to our fellow global investors, because we see the growth opportunity there. Fixed income, different story, of course. The orthogonality really plays into that. We had a large mandate through last year in fixed income, so both rates and credits. We did well out of the rates, unhedged RMB, unhedged rates, and then, of course, lightened up, reduced the allocation to rates, really with the focus maintaining the onshore credit portfolio, which we think we'd like to maintain through the cycle and see that grow in the future. So that's just a bit of context how we think about that equities and fixed income allocation.
But in the longer term, how will you grow? How do you see your China Hong Kong portfolio growing?
Yes. I mean, more on the equity side, eventually grow the credit portfolio to be more about, at the moment, it's really internationally rated credit in limited sectors, but that can grow into third-party allocations as the rate cycle changes again in the future. Of course, as you said, our long-term interest in China, we're a pensions company more than anything else, and it's that huge potential growth of private sector pensions, pillar 3 pensions in China, which is a relatively small market at the moment. But as most things China, given the size of the market, the needs of the aging demographic and government policies, that will be the world's largest private sector pensions market, and needs investment and insurance products to help that develop, which we hope to participate in.
And what would you say is the biggest factor holding you back? If there's more that you would like to do, what's the biggest factor holding you back at the moment?
So on the allocation to let's say that deep tech, clean tech sector, nothing really holding us back there. I mean, we don't have the skill sets. We formed a partnership with a Chinese expert in that area to really deliver that to our balance sheet and to global investors. So just getting on with it, nothing holding us back there. On the pension side, of course, it's how you participate in that market as an overseas institution, and that's really about finding the right partnerships to facilitate and make sure you can address the big point of distribution to private investors, individuals in China.
And I believe that's something on your agenda.
Of course.
Patrick, let me come to you now. I think before we get into the nitty-gritty of what you and your clients are doing, I think it's just worth hearing a couple of minutes on Neuberger Berman's history in China, because there are not many US firms which have the history in China of working as a fund manager that Neuberger Berman does.
Well, thank you. Happy to. I think Neuberger got into China quite early on, I think in 2008, when, QFII, our QFII schemes were set up, which was the first channel for global capital to come into China, and Neuberger took the opportunity and start advising our global investors on their onshore investments. I think it delivered good returns. It built up to a sizable portfolio. I think it is the first effort by Neuberger. The second was, I think, in 2016, when the Free Trade Zone of Shanghai launched a new policy to invite global asset managers to set up private funds with 100% ownership. That's a second wave of effort, I believe, by Neuberger and many other global firms to get into China and set up private fund operation. That license, though, is very restrictive in terms of the assets you can invest in, as well as the clients you can raise money from on the onshore market. But it is to the new announcement, I think, not quite new now, but new announcement 3-4 years ago in 2020, that all the global managers can set up fully licensed mutual fund company in China. That's the third wave of effort by global firms. And we, alongside a couple of other global firms, launched our application on the 1st of April 2020 for the FMC license. And for us, it's been a really very interesting experience of 3 years. So it wasn't until 25th of November 2022 we finally secured the license for a mutual fund. And since then, we have started launching fully licensed local mutual funds in both fixed income and equity. That license really provides the full access to the Chinese core market. You can raise money from investors just coming in with 1,000 RMB or even 100 RMB, as opposed to those when you have a private fund who can only come in with 1 million RMB to start with. So, and also with that license, you get to work with all the key institutional investors, such as, the insurance companies, the endowment funds, and so on and so forth, which weren't available under the private funds. So Neuberger has been through I think 15 years of a history investing in the onshore market and raising assets from the onshore market as well.
Tell us a little bit about the work that Neuberger Berman does advising institutional investors on their investment approaches and the work that you're doing and the advice you're giving to some of those investors around their investment both on and offshore into China.
Yeah, I think that's early days. I think since the QFII scheme was launched, I think global institutional investors, pension funds, insurance companies, sovereigns started to invest in China. But obviously, it's a vast market and it's very complex and, very different regulation. And, even with QFII, the tax code wasn't clarified until a few years ago. So there was a lot of complexity related to that. And you do need a team on the ground that can really look at the market, search the companies you want to invest in, and manage, all the bells and whistles, all the infrastructure around your portfolio. You do need very specific local expertise and knowledge to really make that investment work. And I think that's, what we provide is very much around the investment side of things, but there are other, service providers, the accountants, the lawyers and all that working all towards that scheme. So what we do is we have research team on the ground, sizable research teams. We speak to, the companies, we're doing due diligence trips, we decide on positions. In some instances, we provide such advisors to our clients. In many more instances, we just manage discretionary portfolios on their behalf. So we've done sort of different vehicles with different legal structure around them. And it's been a valuable experience, I think, for the organization to pick up that learning curve about China, the investment culture, the people you deal with, the regulation, the tax office, and so on and so forth.
And what about the role of Hong Kong for Neuberger Berman and its clients?
It is very important. I think we talked a lot about different pipes, right, into China. QFII, RQFII, Stock Connect, Bond Connect, CIBM, Direct Connect by central banks, mutual fund recognition, very recently, the dual counter of Hong Kong dollar RMB trading launched by Hong Kong Exchange. These are great infrastructure to get into China, and these are all built in Hong Kong. And the significance of Hong Kong, strategically, one of the reasons I would argue for China to open its capital markets is, the driver for the internationalization, can't speak today, of RMB, because if you want people to keep RMB as a reserve currency, to your point early on, you need to offer investment avenues for these assets. And if you look around the world, apart from onshore Chinese market, where you can find really RMB investment products, that is only in Hong Kong right now. And I think the significance of Hong Kong is also very much related to the legal framework, the regulatory framework. And I think asset safety increasingly is an area of concern by many investors. And with Hong Kong's legal framework launching these products, although go into China ultimately, but the setup of the vehicle and all that being in Hong Kong, I think somehow provide comforts against that concern.
Any of the other panelists have views on the Connect programs and their effectiveness so far? Kerrigan, do you look at that?
Yeah, well, yes, that's how we run our fixed income mandates, through Bond Connect. So that's certainly being in Hong Kong here as a super connector. It's our main office connecting to our offices and businesses in Beijing, Tokyo, and Singapore. So great connecting from that point of view, but also the pipes that we talked about, Bond Connect and Stock Connect via Hong Kong.
The pace of progress is what you would want it to be, or you'd like it to move faster if it could?
I don't really have any complaints about the pace. It's working effectively for us. So no further comments on that, really.
Okay, thank you. Carl, I just wanted to come back to you quickly. We talked about, obviously, Patrick Neuberger Berman as someone who is there to assist people with navigating their way through Chinese markets. Do you use external managers on your Chinese investments, and if so, how?
For us, we are in the Asian Bond Fund too. So I think that was started a long time ago. And then the rest of our investments in China are strategically done internally by the Banco Central.
That you imagine would stay the same for the foreseeable future, at least.
Yes, given that, as mentioned, we are conservative and we are happy at the moment with CGBs and PBBs and what they have to offer for us.
If I'm going to come to each of the panelists in turn and say, if there was one thing that you would like to see that would help to open up your ability to invest more in either RMB or China, what would it be? Carl, I'm going to ask you first and then give more time to our other panelists to think about their answer. But what would that be?
Yeah. I guess your survey earlier pretty much encapsulated our general sentiment. But I guess an opportunity to attract more flows into China, maybe perhaps for China to capitalize on the mega trend on ESG. So like for the case of Asia, I believe GSS issuances in Asia, China accounts for maybe about 30%, and on the green space, close to 40%. But I guess investors would still find merit into getting into China if there were a bit more transparency. Not to say that there is little transparency. And of course, with the GSS space and transparency becoming a major concern for everyone, it is, I think, a space for Chinese authorities to capitalize on. Yeah, I think there's an opportunity there.
I will come to the topic of ESG, I think, in a second, and obviously it's something we're going to talk about today. But just in terms of those, the one step that you would think would make your life easier or better.
So, as we think about developing out our fixed income mandates, particularly on the credit side, at the moment, to really satisfy our international investors, we're really relying on international ratings. So it's that further maturing of the internal ratings and credit analysis that we need to access. I mean, it's there in parts across China, but we need to bring that into a standard and a format that would be more acceptable for our international investors looking at investing in Chinese credit.
Okay, thank you, Kerry. Mark.
I think it's two ways to look at this question, actually. One is what us as foreign investors would like. But I think I've been asked to speak a couple of times with OMFIF in China over the last 5 or 6 years on this issue. One of the issues for China, and who am I to tell China what the issues are, but I've been asked to speak on it, so just continuing that theme. China is a savings nation, and it has a large savings pool. It's one of its biggest risks is the lack of diversification in where you can put your savings. And they're now adjusting the real estate sector because there has been a bit of over-egging there, quite clearly. So what we would like as foreign investors, I think, is also good for China, which is the development of diversification, more sophisticated asset classes, better regulation, good credit ratings. So it's not just good for us as investors, but I think it'll help the stability of the Chinese savings system and give local Chinese investors the opportunity to be more diversified, which in the long run is good for the savings and the confidence of Chinese consumers, for example. So I think we're all looking for the same thing, and hopefully that trend will develop.
And other examples to date, Mark, of asset classes that have evolved that show some encouraging progress forward?
Look, there has been progress, so I don't want to suggest otherwise. There hasn't been as much in pensions. I went to a sort of seminar 11 years ago because of the importance of giving confidence on pensions, which then enables the savings ratio to get slightly better balanced, for example. But there has been some progress in the development of the listed markets. There has been some private equity, but I just think that the need to diversify the capability of domestic investors to get diversification should be a major theme for the stability of the system. And also that's beneficial, as it turns out, for foreign investors as well.
Very interesting point. And Kerry, maybe just to come back to you quickly, maybe you could speak about how you think the Chinese pension system might develop, because obviously that's something that Mark's just mentioned. I think it's of real interest at how small the pensions market is there now and what it might grow to. We've talked about pools of capital. It could be an enormous pool of capital one day.
Yes, I mean, the way we think about it, we've probably seen some of those reforms starting to come through last year, tail end of last year, the setting up of the potential for the equivalent of individual retirement accounts, the 12,000 RMB per year that you can save into pensions. But that's just the start. That's the increase of the savings habit, the reduction of the financialization of housing. I think will encourage that savings environment that we talked about, that will not be just in pensions, but broader long-term saving to help people protect themselves, give themselves financial security in retirement. That's the big theme that has to happen and will happen, and has started to be evidenced by reforms that are coming through last year and again through this year.
And what type of pension system do you think is like to develop a defined contribution or?
Well, so what we're primarily talking about here is there's pillar one, let's say state broadly, pillar two, a really limited corporate sector, but the real support and flow is in private sector. So defined contribution, 401k like savings pots that can be applied when people get to retirement.
Thank you. Gino, just to come to you on measures that could be taken to accelerate or ameliorate Hong Kong and China's part of the global financial network, I guess.
Yes. Actually, I think in the past, every people knows that Hong Kong is a very important linkage between China and the global economy. But the people are very difficult to find any investment opportunities within China, within Hong Kong, for example, in the island. But I think the very important change is now that the Hong Kong government wants to also develop the technology sector in Hong Kong. So make the linkage between the mainland technology sector and also the Hong Kong technology sector. I think it's a very good opportunities for all of the investors to look at. And yeah, it's a very big story and also needs long-term investments and developments. But I think every people can maybe get some opportunities there and also can benefit from that strategy.
We'll have a panel a little later on today on the Greater Bay Area. I mean, how can Hong Kong benefit from that? It's part of that.
I think the people need to maybe have the opportunity to travel to Shenzhen right now, because it is really very convenient to travel to the Great Bay Area with the railway, with the bus, with all of the communication tools. So I think it's get the people much more easier to move between the mainland and also the Hong Kong by the infrastructure development. It is the so-called hard infrastructure development, but also in the so-called soft infrastructure. I think the development is also there, and I think the people can maybe get more easier to work in the Great Bay Area and live in Hong Kong, and also work in Hong Kong and live in the Great Bay Area. So I think it is the most energized area, economic energized area for within the China.
People have told me that Hong Kong to Shenzhen is now effectively a commute, which is an interesting development. Patrick, from your point of view, what measures could be taken maybe relatively quickly to speed up this process of RMB internationalization, China's role in the global financial system?
That's a very big question. I think, internationalization of RMB, it's basically trade and reserve, right? On the trade side, we talked about the geopolitical situation and how China can navigate that. I think that's a key dependency. On the reserve side, I think, how you build more RMB hubs, such as Hong Kong. And I think Hong Kong will be and still leading in that area, just offering more avenues for people to make use of that reserve and get return. I think these are the two areas of focus if you were to internationalize RMB. More specifically, coming from my background, from investment management, I do very much echo Eddie's point earlier on how you build Hong Kong actually into a risk management center for onshore RMB investments is probably a very significant direction. You don't have such a center anywhere in the world. The onshore market is what we call thin. You don't have many instruments to really implement sophisticated hedging strategies or different strategies. But to do that, you need different instruments traded on the exchange with liquidity and all the rest of it. But the good news is these instruments are usually derivatives. It doesn't have to be traded in China. So that probably is something that Hong Kong Exchange can sort of help build out. And then once you have this risk management approach very well established in Hong Kong, I think in a way that will encourage further allocation.
Swap Connect mentioned earlier, I think during Eddie's conversation as well. Do you think that's a step in the right direction?
Absolutely, yeah. And I think, the recent announced, I think in June last month, the dual counter, so you can trade like Alibaba in both Hong Kong dollar and RMB. That's another significant development. Hong Kong has about $1 trillion in reserve for offshore RMB that can be totally go into those trades without, further currency exposure or fluctuation during the holding period. Further on, they can open that scheme to onshore RMB. So this sort of dual supportive measures will really make the capital markets more connected and more fluid, and allow the capital to flow like water, rather than right now there's a lot of dams built in the middle.
Thank you, Patrick. We're coming into our last 10 minutes or so for the panel, so I wanted to now offer the opportunity for any of our audience to pose a question to our excellent panel. Just pop your hands up if you have something that you want to ask. Stun them all into submission by the looks of things. Look at that. Let's have a think about that. Oh, we have one. Sorry.
I'm Leon from Intercontinental Exchange. I got a question maybe for Patrick. Yeah, I know for China investment, as we mentioned, the ESG is part of the buzzword there. And so, what do you see as the blockage or hinder when doing ESG investment in China? Thank you.
Such a great and topical question. I think ESG is taking ground in China. If you do a quick search on the web, you will see sporadically local mutual fund companies are launching products with ESG in the fund name. Although, if you look into it, with various degrees of alignment to international standards in terms of what an ESG fund needs to be. But that phenomena is telling you, this theme is taking ground. And Neuberger, as a new entrant into the onshore market, we take it very seriously and as potentially a key differentiator. When we were applying for the mutual fund license, CSRC asked us, as a global manager, we invite you in, but we've got 150 firms. Why do we want you in? We want you in because we need you to have some influence in some areas that we probably don't know well enough. And for us, we picked ESG as our pillar for our differentiation, because that is something President Xi somehow committed to, the 2060 net zero commitment, which will lead to a lot of ESG related initiatives. And within these initiatives, we see opportunities for investment. So that being our pillar, and we do believe for a lot of global investors, when they look at China, probably they will be interested in, as a first step, some more ESG friendly strategies. But the ESG landscape in China can be vastly different. The standard can be vastly different. Even the jargons can be vastly different to the West. It doesn't have such a fully developed scheme like you see in Europe, how you classify ESG fund and all the rest of it. So we want to make a serious effort in that. We relocated our MD on ESG investment from New York to China. On the back of that, we adopted a group approach to integrate all the material ESG factors related to China into our basic stock research process. So every stock we can invest in will have a research report, of which there will be a section on ESG, which is a description of what that firm does in that area with a rating. With that sort of base research done, we can launch different levels of ESG product that's really aligned with the international standard. So that's what we're building out. Secondly, also on the back of the relocation of the MD from New York, we have filed, which is public information, our first green bond fund with CSRC, which should be launched within this year. So we really feel this is an area that really needs global experience. They will come up with something that's quite different because China has its own interpretation of ESG, but they need framework, they need support in terms of experiences around ESG investing. So I think it's not just Neuberger Berman. We're a new entrant. We pick it as a key differentiation factor for us. But I think the broad market with a lot of local FMCs are also, setting up ESG committees, launching ESG funds, although their knowledge about, the standards about ESG is still limited. But I guess that's where we can make a difference.
Just to put it into context, Patrick, I think the estimates of the amount of money that will be needed to achieve that transition to net zero globally is about $66 trillion. In China, it's $15 trillion. $15 trillion is the current exact amount that global banks hold in FX reserves at the moment. So that just gives you a scale of the challenge that's being faced right now. Any of the other panelists want to just come in on the ESG question? Kerrigan.
If I can, I mean, what we believe is that we need full international cooperation to make the best use of finance and technology to mitigate climate change. That's the starting point. And of course, you can't ignore China on any of those features. You mentioned the 66 trillion feature. There's many figures knocking around because I'm very simple with figures. I remember the 100 trillion globally over the next 40 years to address climate change. 25 trillion of which is needed in China alone. I mean, a huge, huge investment that will have to come from the private sector as well as the public sector. We know China, 30% of world manufacturing, 27% of carbon emissions, but it's also the world's green giant, of course. It's roughly 90% of the entire solar supply chain, over 50% of electric vehicles, around 2/3 of battery production. So in those key themes of mitigating climate change, of electrification, storage, and solar, which is the main drive to get to a large part of addressing climate change, China's the leader. So what we need to do as fund managers, the main thing we need to do is to connect global investors to that investment opportunity. So that's the flow that needs to happen. And out of that, you automatically get ESG related funds, probably with an emphasis on the E part of that. So we'll be launching a fund later this year, which will be available to global investors investing in those technologies, going through the effort to make that an SFDR Article 8 fund, because you have to go through those steps to connect those global investors with this incredible and important investment opportunity.
Thanks, Kerrigan. Thank you. Any other questions from the floor? Yes, one in the front here, please.
So quick question for Kerrigan and Patrick, because as a lawyer, I also advise many global asset managers and investors. I wonder, I know both Neuberger and Legal & General, you are actually among in the first batch of movers, to do asset management business in China. Neuberger has got the mutual fund license, and L&G also has opened its Beijing office. So I wonder, in your mind, what would be the key challenges and opportunities for global asset managers when doing business in China?
Everyone's been very polite. Go on, Patrick.
All right. I think opportunities, challenges, opportunities enormous as a global manager. I do believe for our industry, two avenues of reform or really growth driver. One is bank disintermediation. So you start to have the huge savings from the bank accounts moving into investment products, including funds. The second is pension reform. If you look around the world, our industry mainly is driven by these two reforms in any particular market. And you map that to what's going on in China. As we all know, PBOC called off all these wealth management products and making it really NAV-based rather than capital protected. That's just going to push a lot of deposits into investment products, not necessarily just funds, but other investment products into the capital markets. Pension reform, LNG talked a lot about, and we are having our eyes on that pie as well. I had the privilege to work through a few mutual funds who have had experience managing enterprise annuity, which is an institutional scheme in China for pension, not mandatory, but they try to model it after MPF in Hong Kong. Unfortunately, it's not mandatory, so it has a limit to how much it can grow. But with the third pillar coming up, you were expecting, I mean, with the workforce, the savings rate, size of the GDP, it's going to be a massive pool of capital. So for global managers, there are loads to do. And again, for us, CSRC or China wouldn't need another mutual fund manager if you don't bring something interesting to the market. And for us, it is to do it very much with the ESG sort of a mindset to it.
Thanks, Kerrigan. Kerrigan, just quickly, please, because I've got the red light flashing. I've got one more question, but please just start from your point of view. Just answer that.
Well, that maturing of the market, the greater balance between institutional and retail leads to that potential for more mature products, such as more multi-asset, target date funds, those kind of products. The challenge is making sure the Chinese public are moving along with the intent and the desire to invest in those sorts of possibly more appropriate products.
Thanks, Kerrigan. I think there was another question at the back. Yeah, just over there, please. This will have to be our last one, unfortunately.
This question is probably for Carl and Mark. We talked about equity, we talked about like CIBM bonds, but can you comment a little bit about like Chinese credit market in the global asset allocation? And then what are the things that you think can improve global access to the credit market, or potentially comment on Hong Kong's role in this? Thank you.
Carl, do you want to go first? Do you own any Chinese credit?
For us, not in the corporate space. And I guess one of the reasons is that it was already mentioned earlier on the need for international ratings agencies to have greater participation in assessing these credit names. So again, perhaps a bit more alignment on how investors can assess these Chinese corporates as opposed to, let's say, non-Chinese corporates would help investors in general. So yeah, I guess that's my only comment on that space.
Thank you, Carl. Mark?
Yeah, exactly the same. There's inevitably foreign investors will be very, very interested in credit in China. There's no question about it. The path, I think, is clear. The credit rating agencies are improving, but need to improve significantly in our view. And then people would need to become comfortable. But with private credit probably being the hottest area globally, there's just a question of time before sophisticated, including Chinese fund managers, want to be in that asset class. And again, I talked before about diversification for Chinese savers. A better structured, well-structured credit market in China is very important for the savings pool, I think, there. But it'll also be great for foreign investors over the medium term. In the short term, very small.
Thank you, Mark. We've run out of time. I've got one more question. I'm going to ask each of the panelists in turn. They have three options on their answers of yes, no, and maybe. But I prefer that maybe wasn't an option. So please give me a yes or no if you can. But if you can't, I'll understand. And it's one just to sort of like stoke the conversation as we go into a break a little bit. We've talked about the internationalization of RMB. You see, it's becoming the desire for it become more of a reserve currency, and yet the Hong Kong dollar is pegged to the current reserve currency in the US dollar. So do the panel, yes, no, or maybe, see the possibility that in the next, say, 20 years, the Hong Kong dollar will not be pegged to the dollar anymore? Whether it be pegged to the RMB or just floating, we don't know. But do any of the panelists, or what do the panelists think, yes, no, or maybe that might happen? Patrick, because you're at the end, I'm going to you first. Sorry.
I'll say no.
Enroll?
Yes means still pegging.
You think it will still be pegged?
Yeah, yes.
Okay. Yeah, Mark?
I think there's a trend to appreciating that a single currency peg isn't that meaningful in some ways, and therefore a mixed basket could make sense. That's possible.
Thank you, Kerrigan.
Still pegged.
Still pegged. Carl, last word to you.
For me, it's still pegged as well.
Okay, thank you. Thank you to all my panelists for a free-flowing, wide-ranging and engaging discussion. Please put your hands together for our panelists. Thank you very much indeed.